Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how to prepare your retirement portfolio for the next market crash. Specifically, I'm going to chat about the inevitability of stock market drawdowns, preparing your portfolio for when things go down, not if, 5 core tenants to prep your retirement portfolio for the next drawdown, how a cohesive plan will give you confidence during the next unprecedented event, and lastly, as always, a few action items for you to consider. So there is a lot of talk right now about the supposed AI bubble, and there are plenty of investors out there that are sure that the entire stock market and economy is being propped up by overexuberance in AI tech of a very small number of huge tech giants. They believe when the bottom falls out of the market, it's going to experience a dramatic crash. And they may very well be right. But here's the problem. The market is where it is today based on a balance between those who think it should be lower and those who think it should be higher. On the other side of that tug of war are optimists who think, among other things, this AI tech is going to be so incredibly transformative that the market will scream much higher once the technology matures. And they think that buying now is a huge discount, and they're happy to get in early before the market goes up even more. So who's actually right? Nobody knows. And anyone who's trying to tell you that they know or have a crystal ball, well, they probably have a bridge to sell you. But I do know this. A crash is definitely coming. In fact, a crash is always coming. That's the part of investing. In exchange for accepting risk of short-term volatility, or what some people call crashes, you get a much higher long-term return. This is the equity premium you accept. The problem, of course, is we don't know when a crash is coming, how big it will be, or when it will end. No one knows this. So what do you do? Well, here's the good news. It's actually pretty easy. Don't try to be tricky. Don't jump in and out of the markets. Don't do some complex analysis to make some sophisticated moves. Instead, focus on consistency. In your accumulation years, it's pretty straightforward. Spend less than you make, stay invested, keep adding money, and let your investments compound and grow over time. When you're preparing to retire or are currently retired, you may want to consider adjusting things slightly to give you a bit of breathing room for when the markets go down. I tell all clients who work with me this exact phrase. Mr. and Mrs. Client, since we're in this relationship for the long haul, there is no doubt in my mind that we will go through a market drawdown together a number of times in the future. It's important for you to know that it isn't a matter of if markets go down, but when and for how long. And my role as your financial planner is to have a plan in place for when the inevitable, unprecedented event takes place, to give you confidence that the decisions we're making today will be able to withstand the uncertainty. So, how should you prepare for this inevitable market downturn as a retiree? Here are 5 things you should consider. Number 1, Ensure you're utilizing low-cost, well-diversified investments. No big bets. You would be shocked if you calculated the compounding effect of reducing your cost of investing over the long term. These lower cost solutions over the long haul will give you the best opportunity for capital appreciation by keeping more of your hard earned money invested, rather than to pay a fund manager to predict the market. Now, I'm not suggesting that just because the investment fees are lower, that they won't be impervious to market drawdowns. But what I am suggesting is that over a 30+ year retirement, you will likely experience 4 to 5 market drawdowns. That is for sure. And during that 30-year time frame, you're also paying for an investment. Here is a very simple example of the compounding impact of investment fees. Say you had $1 million in a traditional bank-owned or mutual fund dealer solution and were paying 1.25% in investment fees. Conversely, you could utilize a solution with a cost of 0.25%. Now, say that both investments returned 7% before the investment fee. Net of your investment cost, the net return of the low fee option is nearly $1.75 million higher than its high fee counterpart over a 30-year time span. I think Canadians need to know this kind of stuff, and I actually did an episode on it a while back. Episode 55 titled, High Investment Fees Are Destroying Your Retirement. I plan on doing another episode of this kind of thing in 2026, as there is an important piece of consumer legislation that is coming into effect in 2026 that will have all of the investment fees you pay disclosed on your year-end 2026 statement. Strategy number 2. Consider a tilt in your investment portfolio towards small cap value investments, whether through an indices holding or low-cost fund. Historically, a small tilt in a portfolio that gains exposure to smaller, profitable companies with a lower relative price leads to stronger long-term outcomes. There is no denying that for the last 10 years, a significant portion of market returns have been driven by the Mag 7 companies, Apple, Google, Nvidia, etc. It's important to have this broad market exposure in your portfolio. However, there is strong evidence that this kind of small cap tilt in a portfolio can have a profound impact during a retirement that can last 20, 30, or even 40 years. Number 3, consider a cash wedge and bond ladder strategy to help mitigate sustained market drawdowns. Now, depending on your investable assets, risk tolerance, and timeline, this strategy can look vastly different from household to household. But the basic structure involves utilizing cash, high interest savings, and target date bonds to have liquidity and funds available during equity market uncertainty. In good years, you replenish the cash wedge and bond ladder. And when equities drop, if sustained, you maintain your retirement lifestyle with the cash wedge or bond ladder in place and you don't touch your equities. Now, I think the crucial aspect here is understanding risk. By holding a cash wedge or bond ladder, there is an opportunity cost when compared to just being fully invested. While if you are fully invested and markets do go down, you may be in a position that you must sell your equity position while they are down. In our practice, we believe strongly in the former, building a war chest of cash, bonds, and secure investments. We find it helps with the psychological aspect of retirees actually living off their money and the emotional turmoil a market drawdown can have on someone who doesn't have a backup plan. Number 4, be willing to postpone trips, travel, or decrease spending. When markets become uncertain, it is absolutely crucial to have an investment plan, as I've just discussed. But that said, while we plan and plan and plan, we do not control the markets, but we can control what we spend. I think it's important to be nimble on what you spend, especially if there is a significant crash in the first few years of retirement. These first few years are crucial for your long-term retirement sustainability and can be drastically impacted by significant withdrawals for large purchases or travel during down markets. So while we do our best to construct a portfolio that can absorb market fluctuations, it's a good thought exercise to take yourself through. The delayed gratification of that trip could have a profound impact on your long-term ability to stay retired. Number 5, make a plan. These suggestions on their own won't hold water. Not when you start to factor in things like the impact of tax when you withdraw income from certain accounts. When you have a cohesive strategy that factors in investment planning with your tax and income, along with your healthcare and estate plan, you can have confidence knowing the decisions that you make today and year over year in retirement are working toward one common goal: a sustainable retirement income for life, regardless of what the markets throw your way. At the end of the day, I'm an investor just like you. I see the advertisements on Facebook and Instagram for people promising steady returns, low risk, a safe haven. I get the advisor ads from investment firms who claim to know which way the wind is blowing, often using fear as the biggest motivator to get you to click. All of this investment advertising you get exposed to is created to engage with your limbic system. This is the part of your brain that is responsible for your basic survival instincts. By using fear or greed, advertisers target your deep emotional decision system, which will often bypass logic. A simple example, I've heard countless stories of investors getting sucked into these online traders who promise to know the market and promise unrealistic returns. The scary thing is, just because you're quote-unquote smart, you're not immune. I guess what I'm trying to get at here is to be wary of people who promise to know the future, when the next crash is, and how their investments will protect you. The fact is, the equity market is out of your control or my control. The bond market is out of our control. Alternative assets are out of our control, and no one has a crystal ball. What you can control is what you spend and how you structure a portfolio to give you the confidence to retire and stay retired, regardless of what life throws your way. Okay, so that'll do it for today. Here are your action items for today's episode. First off, review your portfolio and consider how it would be impacted during different market events. What happened during COVID? What happened in 2022 when interest rates spiked? How was your retirement impacted during the tariffs, if at all? Next, tune out the noise as best you can. When you build a portfolio that you can understand at a basic level, you will gain confidence knowing that when the market adjustment happens, you don't panic, especially if you just retired. Lastly, I hope you enjoy a very Merry Christmas with your friends and family. And those of you who are grieving and missing someone this season, may you feel comfort, love, and peace. Okay, so that'll do it for today's episode. Make sure you're following us on all of our socials. Be sure that you subscribe to the podcast and leave us a 5-star review on your favorite podcast app. Be sure that you're signed up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.